Please welcome your panelists for Institutional Investors, focusing on long-term value in a short-term world, moderated by Chairman and CEO of State Street, Joseph L. Hooley.
Thank you. Good morning, everybody. Thanks for being part of this panel. As you heard, the focus for this next hour is on focusing on a long-term value in a short-term world. And we'll get into that. I've got a terrific group of panelists here, which I'll just briefly introduce. Starting on my right, your left, Chris Ailman, who's the CIO of CalSTRS, the world's largest educator-only pension fund. He oversees some $225 billion in assets. Chris is a 27-year veteran of these wars.
That's why I don't have to hear anymore.
To his left is David Adkin, who is the CEO of Cebus Industries Superannuation Fund, which is one of the largest super funds in Australia, focusing on 75,000 members. And the focus is on construction, building, allied industries, $43 billion he oversees. To my left is Vicki Fuller, who's the CIO of New York State Common Retirement Fund, which is the third largest U.S. pension fund, with $209 billion in assets that she oversees for her participants. To Vicki's right is Nick Mokes. Nick is the CIO for Wellcome Trust, which is a global charitable foundation dedicated to improving health. And Nick oversees some $32 billion in assets. And then on the far right is Juan Manuel Valparina, CEO of Afore 21 Banorte, which is the largest pension funds administrator in Mexico. And he oversees some $40 billion in assets. So just to get things started, you've got $500 billion of assets that are overseen here. Very global, as you can tell. But I just wanted to set the stage a little bit. The world feels to most of us like it's gotten a little bit better. If you look at in 2017, global GDP at 3.7%, anticipated 3.9 to 4% this year. Developing markets continuing to perform, if not outperform. India, a star. If you look at the developed markets, they're in a different phase. They're in the phase of tightening interest rates. You've got 3 of the G7 banks have already started to tighten rate policy, started with the US. Largely anticipated that Australia will kick in this year, maybe next year, the ECB. Yet, it's a market where many people think that equities are overvalued. So I just want to start out, and I'll pick initially on the 3 CIOs of the pension funds and just say, what's in the world of your strategy? How would you lay it out right now? What does the strategy look like? Chris, let me kick it off to you. Just the broad strategy, broad strokes.
From our perspective, the world looks like Goldilocks, not too hot, not too cold. Inflation's not too hot, not too cold. And we just met last week with all of our senior investment staff and looked at the whole world and really didn't find anything that looked compellingly cheap. Everything looks fairly valued. So we're actually staying very close to home, right on top of our targets. If anything, leaning a little defensive because the global risks around the world frighten us. But I think overall, we're not going to take a lot of risk. We're not going to take a lot of risk within the portfolio at this point in time because things just don't look cheap. But we're, the title of this, I want to emphasize, we're long-term. We're looking out 30 years. So while I pay attention to what's going on around us, I'm a cruise ship with a really long-term horizon. Might batten down the hatches, but I'm not going to put into port and call it quits.
And Chris, just stay on your public versus private. What's the tilt there?
We're a very mature pension plan. We're actually 103 years old, so we have a negative cash flow. So we really probably can only afford to be about a third in illiquids, maybe higher, but we're finding that even illiquids are priced to perfection. Even on multiples in the private equity market, cap rates in the real estate market, the lack of infrastructure deals in general, and those that are priced to perfection. So we're a steady state investor. We find those markets really too hard to time, and something like private equity, where you're putting money to work and a GP has 4 years to invest in, you can't pick the vintage year you exactly want. So we're a steady state investor in those markets. Things like real estate, we're getting a lot more defensive. Just deleveraging parts of those portfolio, not trying to take as much construction risk. and really just grow the coupon income. So it's a time where you want to gain those profits. The markets globally have been very positive, as you said, but you're recognizing we're at a transition point with that central bank easing. They've got to unload those giant balance sheets that they've got, and that's going to put pressure on fixed income and eventually pressure on the equity markets.
Excellent. Vicki, let me turn to you. A similar sized public pension fund with a long set of liabilities. How do you think about your overall investment strategy at this point?
So I'm a fixed income manager by history, and so I remember the days, you only got your coupon and a little appreciation, and then your bonds would drop to 30 when things went wrong. So I worry, I always tend to look for the string that can unravel. As Chris said, we are decidedly an equity investor. We need to be, because we're serving 1 million people over the next 30 to 40 years. Our allocation is about 50% domestic and U.S. equities, 30% alts, and the rest fixed income. So what we're trying to do in like fashion is to batten down the hatches, look for the places where there could be information about a downturn coming, and try not to be too cute. We started modifying our our real estate portfolio actually 3 years ago. When we went through the last economic cycle, we had been overweight to opportunistic. And so having learned the lessons of that and remembering that the role of real estate is a diversifier, not a private equity vehicle, we started moving decidedly into core and core plus. In fixed income, we've been upgrading the credit quality. Now, in the core portfolio, we don't go any lower than BBB, but we've been decidedly upgrading that credit quality, shortening duration a little bit. Again, trying not to be too fancy, continuing to invest because we have to. We can't time it. If I had my own druthers and I could move a $210 billion fund to 50% equities and fixed income, I might do that. And it's good we're too large to do that, right? Because I could be wrong. So for the most part, just looking for the things that can go wrong and continuing to ask ourselves, what is going to break this expansion? Because we know they don't die of old age. So that's our posture.
Great. Thanks, Vicki. Nick, let me turn to you. You've got a different situation in that you don't have liabilities, and your focus is on generating returns for healthcare research. But talk a little bit about, maybe just push that out a little bit about who Wellcome Trust is, and then talk about your investment horizon and philosophy at this point.
Sure. Wellcome Trust has been around since 1936. We've got $33 billion of assets, and we're spending about $1.4 billion a year funding medical research. It's the core of what we do. However, we don't have a long tail of liabilities like Vicki does, for example. And that puts us in the luxurious position of not having to own fixed income. And in fact, the strongest view, I guess, we have at the moment is virtually anything which is in the fixed income space is the wrong price. So earlier this year, we were able to issue 100-year debt. So in terms of our time horizon, that's the sort of thing we're doing. 100-year debt, if anyone wants some, by the way, it's yours for 2.5% fixed coupon for 100 years. And it was massively oversubscribed. And that alone tells you something about the state of the markets. What are we doing with it, the other side? Well, it's tough. Stuff is, as Chris said, nothing's cheap out there. There is still plenty of cash flow generation going in big public companies around the world. So we're much more focused on the underlying cash flow characteristics of the assets that we own, rather than what price the market is choosing to put on them at the moment. And by doing that, we can have some faith that the commitments that we've made to fund medical research will be fine. But the other thing that we're doing in a world where, frankly, we think that returns will be lower, volatility will be higher, and rates will be rising, that's a world where we want to be very careful about fresh commitments that we're making. So the other luxury that we have relative to the US foundation community is that we don't have a fixed statutory spend that we have to make every year. So we've changed our spending policy from one which is dependent on the size of the assets that we have, i.e. as they go up, we spend more, to one where we're looking more at a sustainable dividend model. So So, it's going to be a tougher world. It's tough to find value out there. So we need to cut our cloth accordingly. But if you'd like to form a queue around the block for 100-year debt.
There'll be a sign-up sheet on the way out. Juan Manuel, so an Afore in Mexico is a defined contribution structure, I believe. And there's been recent regulation or easing of regulation in Mexico, which has given you some flexibility to invest not only outside of Mexico in more illiquid or more private markets. Describe a little bit what an Afore is and what your investment strategy is.
Well, the Afores in Mexico today represent 15% of GDP, approximately. Mm-hmm. We represent like 4% of GDP. So we're quite large. And with small domestic markets, small domestic financial markets, it's quite hard to make the difference if we're not looking outside Mexico. The investment regime only allowed us 20% international investments. We moved and we worked in a benchmark portfolio for like 1 year, 2016, 2017, and then we implemented the strategy. And part of that strategy, we went a lot more into generating alpha, both in our domestic investments. We have like 17% of our portfolio invested domestically in equity. And we began working a lot more with international asset managers into our international strategy. Before that, we had private debt, we had trackers, but we went really hard into mandates. Last year, when I was here, we were finalizing the process for a U.S. mandate. We have, as of today, like $3.5 billion US, 1.1 billion in the U.S., 1.1 billion in Europe, 1.2 billion in Asia, in 8 different asset managers. And now we have been able to reach the 20% limit internationally. The next step was real assets. The system in Mexico was reformed 20 years ago. And 20 years ago, everything we had was government debt, government instruments. And now we have less than 50% in government debt. So we have been able to diversify a lot our portfolio, but real assets was something that began like 5 years ago. Before that, we couldn't invest in private equity, we couldn't invest in infrastructure, we couldn't invest in real estate. So our average vintage is 3.3 years. We have like 10% of our portfolio invested in real assets in Mexico. And late last year, we got the authorization for investing in real assets abroad. The only conditions are the capital has to be raised in Mexico, and 10% of the capital has to be invested in Mexico. So we're working really fast with the largest players worldwide in seeing how the different strategies will fit in our portfolio, and then defining the roadmap. So by the third quarter of this year, we're able to allocate maybe another $1 billion US, mainly private equity and real estate. We don't see opportunities in infrastructure worldwide versus Mexico. We believe we have very good opportunities. We believe we also have very good opportunities in oil and gas. We have another vehicle that is investing in Argentina, Brazil, Colombia, and Mexico in oil and gas. So we believe that private equity is something where the market has not gave us what we expect in Mexico. And we believe that real estate could be also an option. And although we are obviously long-term investors, we have a paradox today in Mexico. No? At 7.5%, the government debt with inflation below 5% and going downwards, with the reforms having already some impact, we have an inverse spread versus the US, which is not very common, and it's the largest in like 7 or 8 years. For the first time, we have interest rates over Brazil. And part of that is lack of visibility of what will happen with the election, mm-hmm. and what will happen after the election. So that's a paradox, because 7.5 in pesos, it's not easy to beat. So in many of the decisions for us now, we might not be focusing in the short term, but we cannot leave that opportunity go away. No? So that's more or less our situation now.
Great, thank you. David, I'm going to turn to you, and I want to pivot to, the point of the panel is long-term investing, and I'm going to quickly go to, the sustainable, I guess is one way to think about long-term investing. David, as I mentioned, oversees one of the largest super funds in Australia. And in my travels, I would say the superannuation system in Australia is perhaps one of, if not the best, defined contribution scheme. But talk a little bit, maybe a little bit about the fund and how your participants influence your investment strategy.
Okay, so we represent 750,000 members who work in the building construction industry. As was said, it's a defined contribution scheme. 9.5% of a person's salary is allocated into a superannuation fund. It traditionally happens through the industrial relations system, and so defaults are selected by the industrial parties. And so we represent the construction and building industry. In saying that, however, Australia doesn't have quite open architecture, but it feels like it does, because a member can leave you if they don't like you, if they don't think your investment performance is up to scratch, if they don't like your fee structures, if they don't like your brand, if they don't like your servicing. So therefore, there's a lot of thought and competition in the system around how to stay competitive and to retain your membership. So with our fund, when we think about our brand, one of the key parts of our brand is the fact that we can say to our members, our job is to let you achieve a comfortable lifestyle in retirement. We also are aware that our licence to operate is based on legislation and is based on social sentiment. That could change at any time if we are not seen to be delivering. So when we're thinking about that and trying to achieve results for our members over the long term, one of the key components of our brand proposition is on the basis that we say to our members, we take your money and we invest some of it back into your industry and create great returns through our property vehicle, through the knowledge we have about our sector, but we're also creating employment. And that's very important because you need to be in employment to save for retirement. You need a productive economy to be able to provide opportunity to your community. And so we do see as one of our purposes is to allocate our capital in a way that is providing a sustainable economy for our members to work in. Happy to stop there and take the questions we
very
like
good,
to.
Complete system. I want to stay on the sustainable issue, and I sit here uniquely as a public company CEO who every quarter gets up in front of analysts and describes my performance for the prior 90 days and describes a little bit what my outlook is. And most of you are invested in public equities at some level, and you're influential. You know, you sit behind the asset management industry. You're the ones that are really allocating the assets. So my question is, how are you, or what ways can you influence, and it's more the public markets, to think more long-term, to get away from this quarterly, Chris is ready to go here, I guess, help.
Yeah, I want to stop you from thinking in 91-day increments. I mean, it's just nuts. And the way we're doing it is trying to work with other pension plans, the U.S. Chamber of Commerce, the Business Roundtable, to say, look, quarterly information might be useful for a very small segment of active managers. Let's have the CFO. I actually don't want the chairman of the board or the CEO on that call. We can have the CFO just talk about accounting treatment and what's going on. What I want to hear from you is more forward-looking statements, not about the next 91-day period. Who in this room lives their life in 91-day periods? You're not going to go to school and get an education in 91 days. You're not going to lose weight and get healthy just in 91 days. Maybe a little bit, but not a lot healthy. Anything in life that's worthwhile takes a long term. And so I've got 30 years of horizon. As somebody said this morning at breakfast, there are public school teachers going to work today. The dollars they put in our fund today, I need to invest not for the next 30 years that they teach. They're going to live close to 100. So I need to invest those for the next 60 years and basically triple them. to make to meet the obligations. Time value of money is on my side, I can do it. But I need that long-term perspective, and I need the companies we invest in to think longer term. And you don't hear enough boards and CEOs think almost multi-generational, which is you're a bank today. Are you going to be a bank in 50 years? 50 years ago, wasn't even that long ago, I remember State Street Bank had credit cards. And how do you think really long-term and getting companies to think that way? I always say to CEOs, as long as they're public school teachers in the state of California, we're going to own your stock.
Yeah.
We're going to outlive your term as CEO. We're going to outlive the CEO after that. So do us a favor and think very long-term, not short-term. Far too often people cut corners to make those quarterly earnings, and then we pay as shareholders 5 to 10 years down the road with regulations or fines for those short-term mistakes. And Vicki, I know you're on the same boat with us.
Oh, absolutely. I was talking to a CEO yesterday who said that when he announced that the company wanted to make a substantial investment in technology, the stock went down. They had a quarter where they beat earnings. The next quarter they lost by the same amount, and the stock went down more. For us, the sustainability means that, as Chris said, we're going to be there a long time. And so we've decided for a large portion of our equity book to index it. That's a strategy. It's not a default position. And we're indexing it because we don't think that in many cases, not all, that large cap managers can give us net of fee performance. That is why we complement that with a very significant engagement strategy. And if any of you have followed what we do with proxy resolutions, it's not about what the company is going to do in the next quarter. It's how are you prepared? Are you diverse? Are you looking for a diverse board? Do you have diverse perspective? What are you doing about sort of the chemical business you have to make sure you don't get sued out of existence? It's those kind of things that we are interested in. We're not a divester. We face political pressure, each of us in the public fund arena, to divest. But if you think about it, that is anathema to us. Number one, if we divest, we don't have a place at the table, and we don't change behavior. But we do need our companies to be thinking long-term about how they are going to continue to be able to generate their earnings that we seek.
Great. Nick,
I got to jump in because divestment is just, I'm at the front edge of that all the time, and it just keeps me up at night, frankly. You're not going to make the world a better place by negative screening. And I argue that divestment has not brought about social change. And I'll go back and happy to argue with anybody about apartheid because there's a 5-year gap between the pension plans divesting and apartheid finally ending. There's a lot of other things that occurred in the meantime that I think had a much more powerful impact. So you're not going to make the world a better place by selling and quitting and turning your back on a problem. You're going to make the world a better place by engaging the consumers and the customers and talking to management. And instead of asking you to think about, gee, Ron, how are you going to do by June 30? Who cares? My question is, how are you going to be doing in the year 2030?
Yep.
What's the bank going to look like then?
Yep.
So let's think long term, and let's stop. Divestment is just a sell decision.
Yes.
And turning your back and ignoring something, think about it. Does it going to make it better?
Nick and then David. Nick, any point of view on, it's funny, again, I go to my world, I spend time with analysts in the US and Europe. Europeans seem to have a little bit longer view, a little bit more strategic view. I know your investment horizon is not just, or direction is not just Europe, but where do you come out on that? How do you use your influence?
Yeah. Well, I'm a paid-up member of the campaign to abolish quarterly earnings, which actually is starting to happen. There are European companies who are doing it. Unilever has done it, for example, and it had no impact whatsoever on the stock price of that particular company. So it is a huge distraction for management. It's a huge distraction for boards, and frankly, it keeps our team worrying about having to look at the quarterly earnings where they're not telling us anything. I always tell management that, frankly, there is no piece of inside information that you can give me that is going to interest me about your quarterly earnings. I don't care. We hold your stock for the very long term. In the case of the Wellcome Trust, we exist, in theory at least, in perpetuity. We have, unlike Vicky, we've not gone down the passive route. We're much smaller, so we can afford to do things directly. So we own a portfolio. We own about 50 stocks globally, which is the vast bulk of our equity exposure. And we invest in companies specifically because we think they have got sustainable business models. And that means companies that not only look after their shareholders and providers of long-term capital, they look after their employees, their customers, their suppliers, and actually society at large as well. We would define it not as ESG, we'd define it as, if you like, license to operate for a company. And there have been situations where we've not been comfortable that the company is going in the right direction and where we have sold them, but by and large, we haven't sold out of any of the shareholdings in developed markets in our companies for more than 5 years. So we have not had any portfolio turnover for more than 5 years. And that requires us to be right on top of those companies.
Yeah.
So our engagement strategy is not just about talking to IR or talking to the CFO. It's about talking to these companies at every level on some very difficult issues at times. I absolutely agree with Chris that divestment is a really negative way of going about things. And we've been actually, in the UK context, we've been the butt of a specific national newspaper campaign to get Wellcome Trust by name to divest from anything fossil fuel related. There's a small problem with that. We're a charity which exists to improve global healthcare outcomes. One of the biggest contributors, in fact, the biggest contributor to human health is economic development. Economic development today requires energy. Simple. So actually not having the ability for an India or for a sub-Saharan African country to use fossil fuels would be a hugely negative healthcare option or outcome. Now, clearly, there's lots of other strands to it, but these are really complicated issues. And if you're not engaged and talking to companies, then you're not part of the solution. So we want to invest in companies that are part of the solution and recognize that there is a problem. The other thing that we do a lot of is we talk to other shareholders. I'm on the board of a thing called the UK Investor Forum. Anyone who's got substantial investments in the UK, you should have a look at it, because frankly, where there have been issues with companies, rather than just walking away, a big group of shareholders gets together and engages directly with the companies to solve those problems. I think it's constructive engagement is a huge part of what we do.
And Nick, I was going to ask, I mean, it's always a scale question, right? I don't know how many public companies you invest in and how big your firm is, but realistically, how many of those management teams and boards can you engage with at the right level?
Every one of them.
You do? Okay.
We have a very concentrated portfolio. We've got roughly $10 billion invested directly in equities. Yeah. It's spread across 50 companies worldwide, and we know them all.
Great. David, you were going to say something earlier.
So just sort of picking up that, how do we change the game, which is so much focused on the short term? I think this is the question for our industry that's been in front of us for quite a while, and it is frustrating that, frankly, the companies that we invest in are not getting the direct signal from the long-term investors. We've got a whole lot of filters and intermediaries in the process, including the quarterly reporting. As one of those elements. So I think there's a lot of discussion around this. The only way to solve it is concentrated effort. That's where there's collaboration from the long-term investors to work together, and there are a range of ways that happens that we certainly participate in. One thing in particular I did just want to call out in terms of how we're trying to send a signal to the companies that we invest in to be forward-thinking, not backward-looking, is around integrated reporting. So we believe that we want to invest in companies that we can see the quality of their thinking, that they've thought about they've contextualised the competitive environment, and that they've identified what they think is a successful way to be a sustainable business in a competitive marketplace. And so value creation is what we're interested in across the 6 capitals that the integrated reporting uses as a way of being more holistic of thinking of value creation, forward thinking. And so we believe that integrated reporting brings your traditional reporting with sustainable reporting together in a forward-looking basis. We thought if we're going to advocate that for companies, we should do that ourselves. And so for the last 3 years, we've been doing integrated reporting, and it's been a challenge, but actually one of the benefits for our business is that it requires all of your parts of your business to come together and see how each contribution they're making is about value creation for our constituents. And it's really lined our business up in a very beneficial way, but also helps us understand when we're asking companies to think about this framework, what it means for our own business. And have some copies here if anyone's interested in how we've done that.
And I hope it's not a quarterly report.
It's an annual report, but it's a forward-thinking report.
And do you impose that? Do you give people a framework to report against, or is it?
It's completely voluntary. The key thing here really is just talking to companies about the fact that we want them to be able to articulate their strategy for success and for sustainability beyond the next quarter, beyond the next year. That's the key thing. And how they do that, integrated reporting is just one framework, but we found it as a very useful one.
Can I go?
I find go ahead, Manuel.
Well, in my case, 36 months ago, I was negotiating the SDGs at the UN. 18 months ago, I was working in a company that delivers basic staples to poor and very poor communities in Mexico. 14 months ago, I was here. Well, 12 months ago, I was here. But 14 months ago, I came to the pension fund. And I found a team that when they described all the investment process, it was very clear for me that they were looking for the long term, not for the quarter, and that they have very clear views, particularly in our investments in real assets, of the risks that we had to avoid, of the kind of projects that raised concerns, because they didn't want that investment for the next year or for the next 24 months. They wanted that investment forever because they felt that it fit perfectly well in our strategy. At the same time, with the support of the UK government, we had a consultative council on climate change to define some characteristics around green bonds. And we can put into the green bonds also the social and the governance components so that we have everything together. And they wanted the financial system, the institutional investors, to push that agenda at least at the level of definitions and transparency. And I do believe at the end that what we can really make happen is that those decisions that we take and the way we have the approach that require a lot of information that might not necessarily be out there for everyone. No, if we push everyone to have that transparency, to have those elements, that information, with a lot of caveats, because the metrics and the way we measure things, maybe in the environment is easier. If we go to social, it's a lot harder. Maybe governance, there can be some agreements. But at least if we put transparency in front, I think that that's where we can make a change happen. I fully agree that we will not change our approach in our case. Looking away from oil and gas with the reforms in Mexico, it doesn't make any sense. Everyone will be investing there and we are not. That doesn't make any sense. But at least in the way we approach those investments, in the concerns they have, to convince us that we don't have any risk, that they are taking all the provisions in terms of environment. Renewable energy. We had a bad experience with renewable energy because there was a very poor social approach in the communities where the projects were going to happen. Again, it's transparency. If everyone put the information back out there so that everyone can go over that, it will be the market, not only us, that will be taking interest in what they are doing and will raise the hands if we detect something. No? So I think that's something that we can contribute. Maybe in markets like Mexico, it makes a lot more sense Maybe in developed markets, it's business as usual, but I believe that's where we have a good opportunity of making a difference.
So let me pick up on that, the ESG, which is some form of what we're talking about here. For me, the E is, more defined. We've talked about it a little bit. The G is what a lot of us have talked about, which is if you want to influence a company, through governance structures and rules and regulations. The S is more complicated. I think, it oftentimes comes to values. Oftentimes it's a factor of who your constituency is. I mean, if your constituency is teachers and gun violence is the issue, how do you square the circle with the square on issues like that with regard to your fiduciary responsibility for returns and an issue that might be at the heart of your participants or retirees?
So I work for a sole trustee, an elected official, and I am his appointed investor. And obviously, there is a whole host of issues, mostly in the social realm.
Yep.
For-profit prisons,
Sure.
guns, sometimes ammunition, someone's building a skyscraper where there used to be a garden, and on and on and on. And what I have to say about this particular comptroller, he has his places of passion, but I always bring it back to if we divest from prisons, first of all, we don't actively invest in it much, it's in the indices. If we divest from guns, we don't change the equation at all. And then you just have this string because, okay, what do you do about the stores that sell the guns? What do you do about the ammunition? How do you think about guns used in the police force or the Army? And so if you try to limit these issues into one microcosm, you don't get there. But I always say engagement. Yeah. We may learn something sometimes, right? There have been times where, in my own experience, let's say we, sort of had an issue with a pipeline. And from the outside looking in, there were people picketing about that pipeline being built in their community. I have found times where I learned that no, yes, they are, but they had gotten their approvals, and yes, they're approaching it in the right way. Our job is to monitor. So sometimes I may lose some of these divestment battles, but where I always stand with my boss, the comptroller, is I'm an investor. Yeah. I'm not a divestor. I'm a pretty creative investor. So you give me a problem, let me research it, and let's find another way of thinking about it, and let's be part of the broader community that brings about change. We are seeing change in a number of these places. So I have never wanted to divest of anything for one simple reason. If you divest politically, and then you want to go back in because they've corrected the problem, I have found that, in my experience, it becomes politically hard to go back in. So that's my perspective.
You've lost your voice to influence, right?
Well, no, we've heard from Nelson Mandela and others that while he might have liked the divestment, what he was frustrated with is once apartheid ended, the West was very slow to come back in with capital because you had laws on books that you had to then change the law, which isn't a slow process. I think part of the challenge is it gets back to active and passive investing. For many of us that are large, we don't have a concentrated active portfolio like Wellcome does, even though you're active because in our definition, you don't hold an entire market. But as you said, you've held these stocks for 5 years without much change, no portfolio turnover. We hold the entire market as a unit. Right. And that's what's difficult for people to understand. I'm constantly amazed at the voices that we hear. These social issues matter tremendously. And I've been appealing to Harvard Business School, to Stanford, to UCLA out here to study this issue because divestment has not brought about change, certainly since the 1990s. What has brought about social change? And study that so that we can give our members, arm them with something about you want to change some problem in the world. We agree, here's a better way to do it than doing it with teacher 403B money. because in essence, you're using people's IRAs. Little anecdote that I think is rather fascinating is we offer a 403B into the teachers. Less than 10% of them use the social option. And oh, by the way, our major union decided to get into that market and offer a 403B. They didn't offer a single social option. And I don't hear anybody screaming at them. So it's kind of like they want to do this with the trust fund, and the legislature absolutely thinks it's their money, so they love to tell us what to do. The teachers are pretty convinced it's their money. It's a trust fund, but it's not legally defined as one. So everybody's pulling on it and trying to create social change or make a statement with it instead of just trying to fulfill a liability way out into the future. But I agree, Jay. The S is the hardest. We can all agree on E. We can agree on governance. But the S issue really is the eye of the beholder. We just had a breakfast with Hiro Mizuno from GPIF, the Japanese pension plan. We don't own tobacco. We haven't owned tobacco for 18 years. He does an ESG index. Of course he owns Japan Tobacco. It's one of the largest companies, and the government owns it. So it's in his index, but it's not in ours.
And Chris, when you stand up in front of teachers, which you do, I'm sure, periodically, and they're on an issue, how do you respond?
I did on Saturday in front of a group of retirees in Sacramento. It's so hard to try and explain to them a passive index versus active management. So it's like, okay, that's going to be lost. What I talk about is I care about that social issue as well. I want to improve it. But selling it, is that really going to make a difference? And I try to use analogies all the time. So if you give me a few seconds, my analogy to them, which resonates in their world, is, hey, if you don't like your local school board because of the curriculum it's rolling out, are you better off going there and making an appointment and talking to each school board member? And if that doesn't work, then you come to the school board meetings and raise your voice and shout and yell and protest. And if that doesn't work, you then actually find people to run for the school board and try and change the school board to get rid of that curriculum? Or are you better off selling your house and moving to another school district? Because when you sell your house, you're not going to sell it in a loss and a protest, because it's not going to hurt the school district. And does the school district care that you sold and moved? All they notice is that noisy person is now gone. They don't change their behavior. You didn't change the curriculum. You just moved. And at least for them, it kind of resonates of, oh, I got it. That's why selling our shares doesn't really do much. If you want to solve the social problem, you've got to get the right tools. And divestment is not the right tool. We care about ESG. We care about talking to companies about how to operate long-term, how to think long-term, how to operate a bank long-term. That's more powerful for society and for us than it is to just turn our back and run away.
Great. David?
So just picking up a couple of the threads there. So I think what you were describing in our context would be ethical investment options.
Yep.
So around the early 2000s, this was the flavour of the month in Australia to add to your investment menu ethical investment options. And the fund that I was in, we did a whole lot of research at the time with our membership, which were blue-collar workers. It was manufacturing, not construction, but pretty similar. It was a different fund. And the members said, yeah, look, they're really important issues. I'd really like the fund to be able to provide thinking about this. But the epiphany for me was, they said, actually, you're the fiduciary. You're the experts in investing. It's your job to make the assessment and then integrate ESG into the overall decision-making process. You shouldn't be asking me to make that decision because I'm just not armed enough to be able to make that choice. So they did see it as being a responsible investor was important. They saw that as a fiduciary responsibility of the trustee. And to your point, Jay, about the S, yes, it is very complicated. But it's very important that we engage with this, because we need to be a fully risk-aware investor. And that means understanding all of the risks and the social risks. And so, for example, within our industry, construction and building, it's a highly competitive, it's a difficult industry to work in. and a lot of people get ripped off. So from our members' point of view, they want to know that when we're investing in the construction and building industry, we are thinking about responsible contractors. That they want to know that we are only doing business with contractors who fulfil their obligations and are not looking to take shortcuts. But by having that knowledge, actually we turn that into a competitive advantage. But it does require us to engage and to be sensitive to these issues. Again, our members are very concerned about asbestos, given the industry that they work within. So that's a harder one. Tobacco we've divested from. There's only two assets that we've divested from: cluster munitions and tobacco. Everything else we seek to engage. But asbestos is one that we're being asked to turn our minds to, because that product kills. There is no real safe usage. So now understanding the supply chain is sort of where we're going to next with that. But that's come from the membership. That's an issue that they're very interested in and concerned about, and want us to spend some time on.
And does S get picked up in your integrated reporting?
Sorry,
Does the social issues get picked up in your
absolutely.
Yeah.
So again, happy to read our annual report, which is online. We do spend quite a lot of time talking about how we think about S issues and how we report against it.
Great. Let me pivot a little bit to, you can't have any discussion today without technology being a factor. And I'll pose to whoever wants to jump in, the question two ways. One, how do you think about technology as a theme from an investing standpoint? And then the other theme would be, as you're all running organizations, and how is technology influencing what you do and how you see the future?
Just jump in and add, this morning at breakfast, Michael Milken came into our group and talked about technology, the simple disruption in technology, about if you were invested in Blockbuster and you were looking at whether to invest in Netflix. My problem is I was still invested in warehouse records. For those that remembers that. But we find that a challenge, because let's say you understood that social networking was going to be the wave of the future. You would have plowed all of your money into MySpace as a first mover. Technology is permeating every part of investments, not just blockchain and those kinds of things, or cryptocurrencies, but really it's the innovation and the disruption to industries. Companies, to think about the fact that Netflix and Alphabet and Google, that have very small physical plants, but are much larger companies than an ExxonMobil or some of these giant things. Companies used to be more important based on their physical assets and their capital, their physical capital. Now it's all their intellectual capital. So you've got to be thinking about it, but boy, the speed of change of the world is, we can't anticipate it, and it's very hard for us to be with the right company to know, what's the future of the automobile industry?
Sure.
Is it going to be autonomous? Is the future of the automobile Google and Apple, or Ford, GM, and Toyota? I don't know, and I can't bet on that and figure that out. I'm going to have to invest and see where it goes.
Can I just, from a strategy standpoint, we have made a decided focus on technology or software within our private market portfolios for a couple of reasons. There are a couple of managers who have shown us year after year that they can generate premium returns from investing in technology. But from a strategic standpoint, what it's done for us is that we use them to help guide us in our technology investments.
Yeah. Great.
We're in a fortunate position of being small enough to be able to benefit from some of what the guys up the road in San Francisco are doing. So we've got some very good relationships with early stage VC guys. I slightly hesitate to talk about technology in California, actually. But it has been a big driver of returns from us. But it's also informed a lot of what we do in other pieces of the portfolio, because you get a degree of visibility into some of the big things that are happening, the big trends that are out there. It's absolutely the case that you can't necessarily pick the winners, even if you know what the trend is. Right. But it's a head start, at least. I would also say that technology is more than just sort of data and IT and so on. It permeates, for example, the healthcare space. And the individualization, the personalization of healthcare, the impact of genetics and genomics, where we spend a lot of our charitable money, is going to be huge. And that's an area that we've focused a fair bit on as well.
Juan Manuel.
Well, for us, not being able to invest abroad, obviously once we were allowed to invest abroad, we have been more keen into this, and it is part of our discussions with the companies through which we invest, and part of the questions that we ask regarding the approach they are taking to innovative technologies. For example, if they are investing in the car manufacturers, what are they looking afterwards? What are they thinking about autonomous driving and things like that? In Mexico, I think that only one pension fund has invested in venture capital. As of now, we have 3 funds that we are looking after, and we will start investing in them. But it's a new approach. No, I believe we are quite under-invested on anything that has to do with these things. For the first time, we invested in an ag fund, and it was raised by a company from LA. They raise it in Mexico, and they are doing things in Mexico. And I believe we need to move faster. But for us, the easiest way to move faster is to move faster with our partners, with the companies that are investing part of the resources abroad. First, moving them in that direction, part of the funds. And second, getting some of the expertise that we need from that experience and doing the same in Mexico.
Great. So let me wrap up. Long-term investors, I think they've made that obvious, influencing the world, not running away from the world, but trying to use their influence through their asset pools to change behaviors and change, in some cases, companies. As long-term investors, you have to look at long-term trends. What are the trends that out 10, 20 years are going to be influential? And so I'd ask you all, maybe we'll just go down the row, what trend in 10, 20-year horizons are you focused on that you think the rest of the world has underweighted? Chris?
Not a plug for Milken, but I'm giving them a plug. Part of the reason I come to this conference is not to go to all the finance seminars, but to actually spend time out in that hallway. Not that you guys should all run and leave us, but is to go to some of the breakout sessions that are on healthcare, on new technologies, some of those innovations. Because clearly I learned stuff here on Sunday about food distribution and how you grow food and distribute food that I never knew. Business guy, so it wasn't something I had talked a lot about. The demand for food, you've seen the slides out in the hall. Sure. About the growth and the demand for meat. Meat takes so much bloody water and land to produce. That's got to change into the future. So population trends, we talk about it, but I don't think we spend enough time. The fact that India is going to have a bigger population and doesn't have enough schools to actually teach all those children. Just those kind of global profound waves. I think a lot of us see them, but it's taking time to think about, okay, how do I invest in that? But I'll throw out there my random thought is, I bet the food industry changes in the next 5 years, not just because of Amazon, but just technology advances.
Great.
The other would be healthcare.
David?
So to tackle that question slightly differently, I think we haven't talked, or we actually had, Manuel didn't raise it, but we haven't talked about it in great detail. But the Sustainable Development Goals, I think, are the roadmap that investors should be thinking about all the different trends, and each one of them in one way or another has been underweighted in the way that we think about the future and the way we should be thinking about investing. So we've identified 6 SDGs that are particularly relevant to us, and we report against those SDGs, and we are looking to allocate capital to those 6 SDGs that we think, as governments have come together and have agreed to targets to create sustainable economies around the world, and picking up many of the points that Chris has just raised, is actually the work that investors now must get to. It's beginning. We are seeing collaboration around the world around SDGs, but I think much more needs to be done. You can't solve societal problems exclusively through the public sector or through the private sector. It's got to be a combined effort, and we've got a roadmap that has been laid out for us that I think we should now actively work towards.
Excellent. Vicki?
Disruption in all its forms. When I think about here in the U.S., how ill-prepared our workers were for globalization, which led to the populist movement, and you're seeing it all over. I ask myself many times, sort of, if I look at the Russell 1000, which of those sectors may not exist in their current form? And what will that mean for the workers and the executives who are at those companies? I don't think there's some books out here and there, but sort of an integrated discussion on the disruption is occurring and how do we prepare ourselves, our communities, our workers for it.
Great. Nick?
We actually spend a lot of time thinking about this stuff, and I would estimate probably 15-20% of my team's time is spent thinking about what we call tailwinds. What are the sorts of things that might drive us over this longer-term horizon? And yeah, there isn't time to go into all of those, but they include some diverse things. You know, waste management is one interesting one, for example. But I guess it wouldn't surprise you to hear that as a healthcare organization, one that's front and center is the impact of, as I said earlier, genetics and genomics on personalized healthcare and what that means. And actually, the dramatic advances that are being made. We were one of the main funders of decoding the human genome. That's fine, that's stage one. You know what it looks like. Now what you're going to do with it? Actually, what you're going to do with it, now we're spending a lot of money decoding the genetic triggers for the most common cancers out there in the world. Well, once you've got that, what are you going to do with that? Well, it's a pathway into doing something with it. That's fine on the charitable side. From the investment perspective, we identified a large gap in funding this early stage biomedical stuff, particularly focused on genetics and genomics. We put a large investment in, which was actually explicitly a mixed motive investment. And that's actually now done so well that we've converted that into a main return-seeking investment, which has gone into our portfolio as one of our largest positions. But that you're going to hear a lot more about the personalization of medicine.
Good. Juan Manuel?
I will go totally with Chris. I think that health, biosciences in general, many of the things we have seen here, and my only doubt is whether that's something that was going to happen anyway, or by putting it here, it pushes us in that direction, and we end up making this happen, no?
Excellent. So I want to thank all of you for spending the last hour with us. I want to thank the panelists. I should note that there'll be sign-up sheets for integrated reporting on the 100-year bond as you exit. And I just ask you to put your hands together and say thanks to the panelists.